All right, welcome back to the channel. Today we're going to be checking out Paycom, ticker symbol PAYC. And this thing, it released earnings last week and it got destroyed. Like it got destroyed bad. It got destroyed almost as bad as the Seahawks losing to the Ravens 37-3. Yeah, that was rough. So we're going to take a look at this one. We have talked about Paycom and Paylocity. Paylocity also reported, and they dropped about 15%, I believe, on earnings after dropping probably 15% before that on Paycom earnings. So PCTY, you can see they also had a nice sell-off over the last 5 days. About 17% over the last 5 days. So let's go ahead and jump into Paycom and see what we can find. And we can also see that they are sitting at a pretty low point over the 5-year chart. 165 was kind of the low of 2020, and they're sitting at 159 right now. I think they got down to around 145 after the sell-off. You can see that right here for the last 5 days. Yeah, they got down to about 147 or so. So about a 40% drop before earnings, from before earnings to kind of their bottom point. Pretty crazy. So what was so bad about this earnings? Well, Paycom was I don't know. They were trading as if they were going to grow 30% or 30% year over year for, the next 10 years or whatever. And we saw a little damage in that thesis right there. So they missed top line. They beat, I believe, on bottom line. But then they revised down for Q4 and they gave 2024 guidance of 10 to 12% top line growth, I believe. So that was rough. And I don't know if they have the 10 to 12% on the news release here, but it was mentioned in the call. And oh man, so now we have a company that was probably the market was expecting, 20-25% growth over the next 5 years. And then they came out and they're like, yeah, guys, 2024, we're probably going to, only going to get 10 to 12% growth. So interestingly with Paycom and Paylocity, the cash held for their customers, they do earn interest on that. So it's like cash and cash equivalents, essentially. Cash held for customers, they basically will get interest for that sweep account, and I think they have that pretty liquid. It's probably like overnight rate, so maybe like 3-4. Well, overnight rate's probably around like 5% right now, so they could get probably around 4 to 5% interest on that. So interest rates rising was pretty much a tailwind for Paycom and for Paylocity. And if we see a moderation in interest rates, that might be a headwind going forward, but they're definitely not going to have the tailwind. And as some people have pointed out, Paylocity actually reports their interest earnings from those funds held for customers in the reports. Paycom doesn't actually break that out, so you have to kind of do some assumptions looking at their funds held for customers and kind of what they can make on that. So, got absolutely crushed. The narrative from management was essentially that the new product that they're rolling out, which they refer to as Betty, basically makes it to where there are way less errors for payroll. They're basically removing revenue streams from like professional services for payroll errors, making changes. And since Betty is so efficient and so much better and way less error probability, they're basically losing that revenue stream and kind of creating their own headwind. The other side of it would be that, Betty, if this software is going to be really that good, it could open some more doors for them with larger companies in the future. So I don't know. It's a tough one right now because you have to kind of distinguish and decipher what you believe is going to happen regarding their new solution. If it is really that good, it might be a headwind for a short period of time. Then that turns into a tailwind as they get through kind of the churn of getting everybody over to this new software that they have, and then they might be able to resume growth at a normal trajectory, because they might have like a 1 to 2 year cycle where they're kind of changing some of the revenue streams through the business, and it might even out by that time. But when it does even out, is it going to be like 10% growth, 15% growth, 25% growth? So let's get into the financials, and we'll check them out. So we can see that over the last 5 years, they've traded really, really rich. And it's the same thing with Paylocity as well. So the net income yield over the last 5 years, the average has been 1.21. The EBIT yield has been 1.58. The free cash flow yield has been 1.21. The operating cash flow yield has been 1.66. And after their crazy crash, it's looking a lot better, right? They're pretty much probably about 50% discounted to where they were previously. And that's what happens when you have the market valuing something for 25, 30% growth, or we'll say 20, 25% growth. And then they give guidance for 10 to 12% growth, right? You get absolutely obliterated. So we'll see. We'll see what happens. But let's go over to their income statement. And we can see that, obviously they've been a very, very strong grower. Still year over year, they've had pretty decent growth this last quarter. I think they labeled like 22%. But remember, a decent amount of that is going to be from tailwinds from interest rates rising. So diluted shares outstanding, pretty much flat. EPS diluted, growing. Go to the balance sheets, and we can see, there we go, balance sheet. Decent amount of cash on hand, about 484 million. And this does not include the funds held for customers. So that is included in their, let's see, is it there? Yeah. Total current liabilities, I believe, is, 2 billion, because I believe the total current liabilities includes the funds held for customers, right? So if you take total current liabilities and then add in, cash and short-term investments, you'll essentially get the funds held for customers along with their cash investments, total current assets. So they're basically making interest off of that 2 billion, just from holding it for customers. So if you're making interest, like let's say 5% interest on 2 billion throughout the year, like it's going to be a decent amount, right? So, well, actually, what is that going to be? That's going to be what, 100 million a year in revenue, just from going from 0% interest rates to 5% interest rates. Let's see here, free cash flow. You can see that operating cash flow, free cash flow is increasing nicely. We do have SBC. We can kind of see that offset here. But they haven't, even though they have SBC, they've been doing buybacks here and there, so it's kind of been offsetting. Stock-based compensation. Let's see, CapEx. So a lot of their CapEx is probably going to be in R&D, I'm guessing. Ratios and metrics, and this is kind of what I'm interested in right now for this company, because I want to see, as they consolidate all of their customer base into Betty, I want to see if they're able to basically make their operations more efficient, trim back in some areas, and raise those bottom line margins. So we can kind of see, I think they started rolling out Betty to customers in 2021. And we can kind of see that they've had a, potentially you could call that like an uptrend, potentially, maybe, I don't know. It's pretty much flat, but it does look like it's been expanding a little bit. Per share metrics have been solid, trending upwards. Let's see, per share metrics per year. Here we go. Up to about operating cash flow per share, $6.30 in 2022. Net income was $485 2022, and free cash flow is $391 in 2022. So we can see that they did. That's so funny. they purchased $75 million in stock over the last quarter, and then their stock price crashes by 40%. Like, come on. I mean, it seems like everybody is just horrible at stock, like share buybacks. they always start doing it, and then just, yeah, release horrible results. So they do have some more firepower in their stock buybacks. They have started paying a dividend, 38 cents per share. So pretty much a smaller token dividend, nothing crazy. Dividend payout ratio is about 28%, it looks like. And yeah, with that, let's go ahead and get into the valuation. So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord. Or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. All right, so let's go ahead and first let's look at the yield metrics over time. This is actually a good visual of margins over time. Obviously, really good gross margins, kind of expanding bottom line margins. So, I mean, quantitatively, like the numbers have looked pretty good over the last 10 years, which is probably why this thing traded so rich. So if we look at the bottom line yields, just how the market has priced this over time, we can see it's been priced for like at really low yield multiples, which implies that the market is thinking it's going to grow at a pretty dang high rate. And if we look at the growth rates actually over the last 5 years, bottom line growth rates has been about 32%. So they have grown at a nice clip. And over the last 5 years, revenue growth rate has been about 26%. So really freaking good. Yeah, so it's good, but when it changes, it's bad. Because if you go ahead and say, this is just the average over the last 5 years. I'm not changing anything. We're taking averages, or we're extrapolating what the market is going to potentially price this at. We look at 20% growth over the next 5 years. That's probably what the market was assuming, with a 2% yield multiple. And that would get us at a base case in 5 years of 790, right? And that's probably what the market was expecting. I mean, let's just look at the 5 year of this. So this stock has topped out at $547, right? It's down at, holy crap, 159 now. So it's down 70% from highs. Jeez. Oh my gosh. Holy crap. So yeah. So the market was probably pricing in that, it's going to grow at 20 to 25%, somewhere in there. And let's see, if we do 20 to 25%, and let's go ahead and say that, its 5 year target price would probably be anywhere between 790 to 1500. But out of nowhere, if we change this, right, and we say, okay, now we're going to remove a lot of that growth, and the target's going to be about 15% in the base. Actually, let's not do that. Let's do, let's go ahead and say that's, go -17, and the target in the base case, or the scenario 3, is about 12.69% with a 2% yield, which this would change too, because if you're lowering their growth rate, then you're going to pay pretty much, you're not going to pay as much of a premium, right? So what I'm going to do here is I'm going to add about 1% here, 1.15% there, 1.15% there. I'm going to get this into a more realistic multiple for that 5 year target. And here we have growth between 10 to 15.66%, with ending multiple of basically bottom line yield of 4.16% to 2.43% in the best case scenario. So, and that kind of gets at the higher end, it gets our target, 5 year targets to about 366 to 545. The lower end targets would be about 251 or 302. So it's starting to get interesting. I'm not gonna lie, it's getting pretty dang interesting. If I was gonna, how I lean for this on the valuation is that, okay, maybe they might be able to do a little bit of buyback. So let's put neg 1% right there. I think so. If you're doing about 10 to 12% top line growth, they probably have the chance for margin expansion. So they could get up to about 15.6% right there in the bottom line growth if they have a little bit of margin expansion. We're going to take the multiples that the market's going to give it, and we're going to say that the market's going to not value it as richly because it's growing slower. So our yields are then, let's see, what is it? The max is 4. We could probably do a yield spread between like 5% and 3%, I would say. So maybe we change this up a little bit. 1.25, 1.5, maybe a little bit more, 1.5, 1.75, 1.75. There we go. 3, and we're going to do a pretty small increment. We just want to get that lowercase to about 5. 7, 7, 7. Let's try 8, 8, 8. And there we go. So that's pretty close. Close enough. About 4.98% multiple, yield multiple in the worst case scenario, about 3% yield multiple in the best case scenario. And yeah, that brings our 5-year targets for this from anywhere from 215 to 467. So if we're looking for a 20% CAGR, if they are paying a little bit of a dividend, and that dividend yield is actually going to be around, I think, 1% right now, because about 1%. So we could probably do 16.5, something like that, and that's a target rate of 19%, margin of safety 2.5. Base KR 16.5 gives us the 19. Then we'll have about a 1% dividend, and it kind of puts our buy prices anywhere from let's see, scenario 1 would be 87, scenario 2 would be 104, scenario 3 would be 126, scenario 4 would be 154, scenario 5 would be 188. But I think, I don't know, maybe I'm being too stingy on this one. Maybe I feel like I should probably lower these a little bit. 1.25, because I think it could trade a lot richer in certain cases. 15, 15, 15. Let's do 20, 20, 20. Because if they do see a turnaround and Betty, this software turns out to be like the next best thing, and they're able to break into new markets, kind of larger customer base, then we could see some pretty good premium given to them in the future. So 2.5, yeah, I don't know. It's very interesting. It pretty much all comes down to what Betty is going to do. What's Betty going to do? Because if we do, say we go ahead and give them up to 20% growth on the bottom line, just from a pickup in growth after 2 years and maybe some margin expansion, we get down to about a base buy point of about 150. So in this scenario, we are targeting 19% CAGR with, so that's 16.5% with a 2.5% margin of safety, about 1% dividend yield. Our dilution rates we're doing buybacks in scenario 1 of 0.63% to buybacks in scenario 5 of 1.21%. Bottom line growth is anywhere from 10% to 20%. Our future average yield spread multiple, or average yield multiple, is in the worst case scenario 1, 4.9% yield multiple. In the best case scenario 5, 2.5% yield multiple. And that gives us a 5-year target price of 217 in scenario 1, 284 in scenario 2, 373 in scenario 3, 494 in scenario 4, 664 in scenario 5. With our target CAGR that we're trying to get, scenario 1 buy price would be $88, scenario 2 buy price would be $114, scenario 3 buy price would be $150, scenario 4 buy price would be $199, and scenario 5 buy price would be $268. So that is it. I think this is probably the numbers that I would go off the most, or I'd feel more comfortable with, because they do have a really good business. if we saw them slowing down and potentially declining, or we really got confirmation that other players were taking customer base away from them and it wasn't just this internal churn transition, I'd get way more concerned. It's going to be a very interesting one to watch. I'm definitely going to be keeping an eye on it and seeing what they report over the next couple quarters, because I really want to see how this shakes out. It could potentially be a really good long-term opportunity, but you know what? There's a decent amount of unknowns right now. And if this negative momentum keeps up, hey, maybe we go see the low hundreds, who knows? But if anybody watched the live stream, 3-4 months ago that I did with Andrew, we talked about Paylocity and Paycom, and my biggest issue was they were just so expensive. They're priced so steep. They're priced for a lot of growth, and they're priced for basically no risk. That's starting to change. They're starting to get priced for a little bit lower growth, and I think more risk premium is starting to get baked into them. So it's making me a little bit more curious on these two names of Paycom and Paylocity. So I'll probably do a video on Paylocity in a couple days or so. But anyways, hope you guys are having a great day, and we'll catch you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.